Today, we're going to look at a strategy that traders can use to earn a pretty consistent income. They're called credit spreads. So we're going to talk about how you can turn options trading into a revenue stream. The best part about it is your risk is managed. Now, credit spreads, they may sound a little complex, but they're just about selling one option and buying another within the same expiration cycle. Now, the income, that is the premium that you get up front. Now, your goal is always the net premium that you pocket. And the beauty of credit spreads is they cap your potential losses. But you got to remember, the trade-off is a limited profit potential. So let's talk about pros and cons first. So with credit spreads, we've got a calculated risk, and we also have our calculated income that we can plan around. Plus, you get to design how that trade sets up, the details of the trade. But there's a cap on how much you can make, and the required margin that you need for this can tie up your capital. Now, there are two main types of credit spreads: bull put, for when the market outlook is high, and bear call spreads. And that's when the market's not the best in terms of bullish activity. So with bull put spreads, you're the optimist. You're selling put options at higher premiums. You're buying cheaper ones for safety. And with the bear call spreads, you're the bear in the market. You're selling call options. You're getting protective calls just in case the market goes against you. So let's look at an example here. So you're into ABC stock, and right now it's trading at $70 a share. You sell a put option for $65, and you get the premium of $200. Cushion your risk, you buy a put option for $60. That's the strike, paying $100. So if the stock stays relatively the same or climbs just a little bit, you made a neat $100 after your safety net's expense, right? You got to pay for those. Now, a bear call spread, so you're trading options on XYZ stock, and let's say it's $100. You're expecting a slight drop in price, so you decide to set up a bear call spread. Here's what you do. You sell a call option. So you sell a call option with a strike price of $105. And let's say for that, you get $4 a share. Buy call options. That's what you're going to do next. You buy the call option. The strike price is $110, and that costs you $2 per option, $200 per share, so $200 per contract. So your net gain from these trades is $2 per share. That's the $4 that you received minus the $2 that you paid out. Remember that options contracts are typically 100 shares, so those are multiplied by 100. So if XYZ stays below $105 at expiration, you keep that $2 as profit. That's $200. But if the stock goes above 107, because that's going to be your break-even point, right? That $2, you start losing money. And the most you can lose is $3 per option, which happens if XYZ rises above $110. So in a nutshell, you profit if this stock stays below 105, and your risk is limited to a $3 loss per share if it climbs above $110. So this strategy caps your potential profit and your loss, makes it a controlled way to bet against a slight rise in the stock price. So as you've seen with both of these, it's all about how you're looking at the market. It doesn't matter if you're bearish or bullish, but you're always prepared for either or. And that's the essence of profiting with credit spreads. Now, a consistent income and the risk management, it's just about knowing the strategies, having some knowledge, and making adjustments depending on what the market's doing. You got to analyze the market. You got to manage your response to it. And the result, you get a balanced portfolio. Now, it is essential to diversify how you generate income in general, right? It's similar to credit spreads. You got covered calls. You got dividend investing. You got peer-to-peer lending. There's a whole bunch of things out there. But every strategy is going to come with its own set of risks, its own rewards. So you got to pick what suits your appetite for risk and the long-term goals. And I tell you, if you want more options info, especially on credit spreads, you got to reach out to Mike here at NetPicks. He is our in-house options specialist, and credit spreads are his favorite trade. And it doesn't matter if you want zero-day options to regular income strategies like this, Mike is the person you want to get in touch with. Send him an email, mike@netpicks.com. Thanks for watching. Talk to you soon.